Welcome back to Market on Close, Market on Close here on the Schwab Network. I'm Tom White. Let's bring in our next guest. That's going to be Collin Martin, Director and Fixed Income Strategist at Charles Schwab Center for Financial Research. Collin, taking a look at the market volatility that we've seen in the bond market, treasury market at this point, I think it lends some credence that we're seeing a little bit of a reprieve the last couple of days. What are your thoughts on, are we going to continue to see that? Or are we okay for the time being, at least?
We might be okay for the time being, but over the next few weeks, we would expect volatility to remain somewhat elevated, given all the uncertainty out there. I feel like every day we get kind of conflicting things coming out of the White House and various administration officials. So it's tough to really gauge what direction we're going in. I think that's the key thing weighing on the markets right now. Obviously, economic data as it comes in, that's important for the direction of yields, direction of Fed policy. But right now, I think the markets are really still focusing on what's the plan for tariffs after the 30-day pause is up. So I think we'll expect to see some ups and downs here for the next few weeks. But I'd say the fact that things have calmed down a little bit, and if we just look at the past week or so, that the 10-year Treasury has been in kind of a tight range, that is a step in the right direction.
When you look at, what caused maybe some of the market volatility, Trump kind of going after Jerome Powell, making a reprieve, kind of flip-flopping on that settled markets here a little bit. But, with the Fed expectations, every president wants lower interest rates. They just don't maybe say it with a megaphone. But at this point, with the expectations for no rate cut in early May at their meeting, June starting to rise up here a little bit. What do you think the impact to the Fed is? Because I just don't feel, Collin, and maybe you feel differently, is the fact that we haven't seen the full impact of what's gone on over the last several weeks in the markets and the hard data at this point.
No, you're absolutely right. We haven't seen it yet, and it's going to take, I think, not just 1 month. It's not like we're going to get April's data and suddenly have an idea of how all this is going to play out. I think it'll take a handful of months. If you go back to what's going on with the Fed and Trump constantly talking about it, I think you're right that most presidents, most administrations want lower interest rates. You don't always get kind of the vocal headlines that we're seeing about the need or want for the Fed to cut rates. I think it's good news that Trump kind of backed off a little bit. If there was a risk that they'd look into firing Powell, I think that'd be bad. I think a lack of central bank independence would be a really bad thing for the U.S. We've seen instances in the past where there's been specific pressure about doing what's best for the current administration as opposed to what's best based on the Fed's mandate. And we've seen it happen in other emerging market economies, and usually the results are not that good. So I'd say it's good news that they've backed off there a little bit. And I'm hoping that continues. At the end of the day, Powell's term as chair ends next year. So I'm hoping and hopeful that the administration will just let him finish out, and then they can worry about a new chair next year.
Yeah, I think Bessent and Lutnick had something to do with that, calming everybody's nerves, maybe straightening things out on that front. You look at the yields here, Collin, 10-year at 4.3%. It almost feels like investors want maybe some consolidation because everything can get a little bit more comfortable with some consolidation. We've seen the reaction in equities, but is that the key here moving forward that, hey, even if they don't go up, they're not going to go down much, but some consolidation would really help ease investors' anxieties at this point?
Yeah, I think it would, and that's a really great way of describing how we're kind of talking about it with our clients, where there really are two-sided risks if you're either too short with your maturities with bond investing or too long. If you're too short, and we find that a lot of investors are right now, given all the uncertainty, a common question we've heard from our clients here are, should I just dump all my investments, whether that's stocks and bonds, and move into cash? And we don't think that's the best approach because there is reinvestment risk there if the Fed does cut rates as we expect later this year. Now, on the flip side, volatility and yield fluctuations can be a big problem if you have long-term bonds. So if you're in a 10-year, a 20-year, a 30-year treasury or corporate or municipal bond, and yields only jump, say 20 basis points, which is what we could get back to those levels based on what we've seen over the past 10 days or so, that would lead to a pretty sharp decline in the value of those bonds. So we kind of like intermediate term bonds rather than taking kind of a bet either way. We don't want to be too short. We don't want to be too long. And if you focus on intermediate term bonds, we think those yields are attractive. We don't think yields are going to move sustainably higher. Maybe they trickle up a little bit from here. Maybe the 10-year even gets to 5% over time, but we're not expecting yields to get to 6, 7, 8%. So it's not like investors need to wait for that before they get excited. And on the flip side, we're not suggesting you go into all short-term investments because there is that reinvestment risk once those Fed rate cuts arrive.
Yeah, I think that's a great point as far as not maybe going out as far in duration at this point because there's some attractive yields in the near term. All right, great discussion, Collin. Have a great day.